Hi, I'm Sandeep Patil. I am a partner at QED Investors. I head our investments into Asia.
Ambitious founders trying to build their startups as rocket ships need to win over an integral stakeholder, and that is the venture capital investor. After all, they are the ones who supply the fuel for the rocket ship. Conversations with VCs are truly fascinating. They have a completely unique lens with which they look at startups. A VC is able to look at a startup dispassionately and analyze it by using his understanding of the market and his thesis on what kind of business models will scale. In this episode of the Founder Thesis podcast, your host Akshay Datt talks with Sandeep Patil, who is the Asia head of QED, which focuses on funding fintech startups. In this candid conversation, Sandeep shares his thesis on why India, why fintech, and what kinds of businesses model scale. This conversation is a masterclass on how to build a startup that attracts global investors. Stay tuned and subscribe to the Founder Thesis podcast on any audio streaming platform to learn about building rocket ship startups.
In many ways, Capital One was the first fintech that ever was. We were very big on data and very big on technology. When I joined in 2001, that time the joke around the company was that we had the third biggest database in the United States, CI being the biggest, right? Because we used to download, like anyone who would apply for a credit card to Capital One, we would download their bureau file. A bureau file would have last 7 years of your financial transactions. I think, if I recall correctly, again, some 800 different data points per user is what we would look at. We used to pay fairly little attention to the FICO score, but we pay a lot of attention to what exactly is sitting in your data file.
And
And
FICO, for
so,
people who don't know, is the CIBIL
credit
equivalent.
score. Yeah, it's a credit score, civil equivalent. And Capital became renowned for its ability to leverage data to drive better outcomes for the customers. Famously, we were the first half of the first decade. Capital One was the biggest credit card originator in the United States, bigger than Citibank, bigger than GS Manhattan, bigger than any other institution. And we are very strong in the super prime end of the market. So very low risk customers, we're able to parse their risk even better than the best lenders out there, better than Amex, I would say. Right. And then on the other side, on the subprime, so new to credit group also, we are very good because these guys don't have well formed bureau files. Either data is not very deep or it's very sparse. And we are able to parse through that data to identify which are the nuggets of information that will help us understand that this customer is relatively low risk. Right. So, anyways, Capital One, not only was a fintech in that sense, but it was also fintech in its operations. It was completely meritocratic. So for a 20-year-old joining Capital One, I think within 6 months, I was responsible for 7 million inactive users, trying to get them to reactivate. So I was running a quintessential P&L, if you will. The P&L was zero, to be precise. No revenues, no losses from this portfolio. But when I did start growing it, that responsibility stays with you. So when you're doing a program on them, a marketing campaign on them, activation program on them, you measure the test and control, and therefore you quantify how quickly. 4 years later, the team I ran was called Balance Bill Team. That was the largest asset gatherer for the bank, right? So if my company, asset gathering to be precise, is people who have credit cards with Capital One, we would get them to transfer all other debt to Capital One because the interest rate on the card was lower than whatever installment loan that you have, auto loan you may have, etc. So you get them to move that over to the card. And that became the largest driver of growth for the company. So for a company, look, I would claim credit that I'm amazing and therefore they gave me this responsibility, but equally and perhaps more, right? You have to be in a meritocratic organization that can see the value of kind of this kind of thinking, right? Unsurprisingly, right? I'm a big fan of Capital One. I'm a big fan of the folks there. So when in 2020, Nigel called, Bill called, eventually I spoke to other folks at QED, most of them are ex-Capital One. And this was essentially Capital One alumni diaspora coming to venture capital, right? That was the core operating model. And that was just marvelous. It was too hard to say no to. Right. There are other kind of structural reasons as well. Look, today is actually a great example, right? If you go back and look at India and venture capital market, most tourist funds have vacated the space. Right.
Tourist fund. That's it. You like
Yeah.
a tourist fund. Give me an example of a tourist fund.
Explain the tourist behavior, right? Which is I, as an investor, have an allocation this month because we raised new fund. So I have an allocation. So I'll fly down to the hottest geographies, sign up 2, 3 deals, right? My allocation is done. Then I'll fly out, right? And then till the next one gets raised 2 years, 3 years later, you won't hear much from me. I won't bother you much either. We'll track the performance 2, 3 years later again, another return to happen. So I didn't want to be part of tourist fund, right? Because they don't have any vested interest in building the ecosystem. They want to benefit, right? They contribute also, to be honest. Capital is not a small contribution. So they contribute to the ecosystem also. But I wanted to be part of a story where we actually help build an ecosystem. And QED had demonstrated that, right? QED entered LATAM in 2015. It used to be a US fund before that. I think 14 or 15 is when they entered. But after that, systematically, they work with the ecosystem to build it out. To the extent that today QED is one of the biggest funds in LATAM, right? I think all but one unicorn, at some point someone had done that, all but one unicorn has QED investment. In 2021, that was signed. So very significant player, but also work with the seed investors, work with angel investors, work with the
Like
founders
they
to
really
build a better
embedded
community.
themselves into the ecosystem.
Yeah, embed themselves so that kind of they become local or native to the land, but also embed themselves in the sense of building the capabilities, right? Like contributing to development of founders, development of companies, volunteering their own time to speak with people when they don't have, when we are not even going to invest. So we measure an NPS as a venture capital fund, which not many VCs do, and it always sits at high 80s for that
And
reason.
who is the audience? This is like
All
NPS
the
from founders, or
Yeah, NPS from founders. NPS from founders. So when Nigel and Will and others approached me, then this felt like the right proposition, right? Because I wanted to be part of this investment story into India, but I also wanted to be part of a player who wanted to be a long-term ecosystem oriented player, and QED was all of that. So it made a tremendous sense to join the fund.
why did they want to enter India? Like, what excited them about India?
So to be honest, when I joined, we were thinking about, will it be India? Will it be Southeast Asia? Will it be other parts of Asia? Because that time even Far East was a thing we could think of. Would we go to Australia, for example? So when we joined, it was test and learn with me joining as well, that I'll build out the case for what exactly we want to do in the broader Asian geography, very, very candidly. But we very rapidly then centered around India. And hindsight is 2020, but I would say our thesis was driven by three main factors. Right. The first factor is the macro part of the story. So everyone raves and rants about India being like what now the fifth largest economy in the world, GDP growth rate of 8 to 10%. It becomes national news when IFC or someone revises up or down that number. Right. These are catchy headlines, right? But that's not what gets me excited, right? What gets me excited is if you look at global economies, how they have performed over the last 25 years. There have been three main crises. There was for us who are quite old and up there, I would say like .com and 9/11 was the first crisis, right? Because .com caused tech valuations to go down. Oil crisis following 9/11 caused a bit of inflation. Here in UK, there was a credit downturn. A lot of economies express had some credit event because of it. That was the first crisis. The second big crisis was 2008, and Lehman was again the crescendo of it, but 2007 onwards, subprime went up. A lot of investing activity went down. All the regulations that came on banks in 2008, 2009, 2010 even caused to the fixed income crisis in 2011, right? So that 3-4 year period was a fairly long, just period for global economies. And then the third period being the pandemic and the war in Europe, right? That whole thing that is precipitating. And in all of those three periods, what you would observe unequivocally for India is that there's a bit of a plateau, if you will, right, in the economy, but then it bounces back stronger than before in each of those episodes, right, consistently. And the reason then could be varied, but what it tells you as an investor is that what is happening foundationally in the economy is strong. We used to think of macroeconomics when we studied, right? It used to be number of people times productivity, right? And when you see an economy consistently demonstrate this trend, that means productivity is structurally improving, right? Factories are better, roads are better, electricity supply is better, utilities are better, people are more educated, there's more investment being coming into the country, and the investment is getting deployed the right way. Things are not getting lost to corruption or just transmission losses. Right, exports are improving, imports are improving, value add by the manufacturing sector is improving. All of those factors, right, start coming through, and depending on the crisis, you can take which ones were really responsible. But that macro story is very strong for us from that perspective, right? The fact that you're resilient, right? This is here to stay. This is a phenomena that will continue for some time, right? So as an investor, it gives us a lot of fun. The
Plus, there's
second part of
it also
Sorry, go
acts
on.
as a hedge while the rest of the world is getting more badly
Yes.
affected as compared to.
Yeah, it's always easier to swim downstream, right? So if there is macro current is flowing the right way, it always helps you get far better investment return, especially in venture. There are other parts of investing which may benefit from still waters and even swimming upstream. But in venture investing, it's very true that you want to flow with the stream, right? So macro was a very important factor. Second important factor was us, right? So both financial services and technology as verticals. So technology is the easier story. I'm sure your viewer listeners know internet adoption has gone through the roof, cheapest cost per unit of data, largest data consumer in the world, yada yada, right? Like in Flipkart, I looked at a bunch of these numbers very closely. I presented a bunch of these numbers very closely. So story was very clear. But even outside, right? All of us can talk about how great e-commerce story has been, how great fintech story has been on back of it. But technology adoption is phenomenal in the country. I think the part that I want to talk more about is the financial services growth, right? The fact that in India we have
QED is
had,
focused on fintech as an investment.
yeah, we are globally, we only do fintech investments. So working from that Capital One heritage, fintech is what we focus on. On the financial service side, India has had professionally run banks for a long time, but also with government initiatives, the penetration of core fintech products, right? Core financial services products, sorry, has been very deep, right? And as a bank account, UPI success wouldn't have happened without supporter stance from RBI and without all the efforts of NPCI, right? And UPI is the tip of the iceberg, right? There is a huge RTGS, IMPS kind of system that sits on top of it. Technologies that have been adopted wholesale by banks is at the heart of KYC, the JAM ecosystem that came about. And even now, right? Open framework being drafted, AA coming live, right? Such a phenomenal initiative that you can get access to any bank account within seconds for last 3 years with information flowing directly from your financial institution without being captured by any intermediary. That is mind-boggling how powerful that framework can be.
And
So,
yeah, I think it's unparalleled. There's no other country which has done that, right?
no, a lot of countries have done open banking, but it's quite crude and rudimentary compared to what India will witness. And like next 3-4 years will be transformational. I think ANK has the capacity to even put
Just to
credit bureaus-
clarify, is account aggregator framework for our list.
Yes, exactly. Yeah, so it's account aggregator framework. What it allows is, so if I ask you, Akshay, then with one consent, you can allow me to get access to all your bank accounts for last 3 years, where the data will flow in a structured manner. So it's always readable directly from your banks to me without anyone else being able to tap into it in the middle. No matter who the intermediaries, the data will always flow directly. And so because it's coming directly from your financial institution, the veracity is very high. Because it's coming as structured, it can be readable. And third, there is phenomenal amount of data protection around it, so no one can intercept it or read it. And then the real power comes. I guess the power also comes. The real power is here only, but the power also comes from the fact that you can tack on other databases. You can tack on insurance on top of it, taxation on top of it, etc. So it just becomes more and more powerful. So what we thought of bureaus, like I wanted to read your positive and negative information when I was going to lend money to you. Now I can get that or probably far better quality information through AA, right? And then that opens up all kinds of cross-sell initiatives for asset management, for insurance, blah, blah, blah. Such things would not have been possible had the financial services and technology because had not grown that fast. We can talk about RBI and how the ecosystem has reacted and so forth. But as an ex-operator, I'm a big fan of RBI, right? For two main reasons. One, when I look at them as a regulator, they haven't had a big credit event, and it's truly big, right? Like economy shattering big event hasn't happened in last 20 years, right? So RBI has not let anything blow up on its watch, and that's phenomenal. That actually is probably a set of one when you look at it globally, but few, for example, right? MS also, I think, has very distinctive track record. So there might be a few regulators who sit there, but that's a peer group you're talking about. The second part is forward looking, right? Things like UPI won't happen unless RBI didn't enable it, right? There are a million ways. I'm sure people have lobbied to slow down UPI, things that could have gotten it distracted, blah, blah, blah. So I have a lot of respect for RBI from that perspective. Second aspect is to the extent that a regulator can provide you clarity in terms of what can and cannot be done is phenomenal, right? Because this kind of causes a bit of a speed bump, if I may call it, for a lot of fintechs today. But then the direction of travel is very clear. ये कर सकते हैं, ये नहीं कर सकते, right? You can do this, you can't do this, and this is how you do it, right? And that then it feels like you're constraining innovation, but actually what happens is when you direct innovation, the output is far phenomenal, right? So I would expect some very creative solutions, very innovative solutions to come out of India. So going back to, right, macro was one part of the thesis, sector was second part of thesis. The third part of thesis for us is talent, right? And so India has phenomenal talent especially from tech perspective. A lot of venture capitalists will rave about it. A lot of people would rave about it. And it is true, right? And the only thing worth pointing out there is it's not a last 5-year or 10-year phenomenon. India has had phenomenal tech talent, at least since 80s, right? When we were growing up, TCS and Infosys used to take students by truckload to their campuses, right? And those guys have put in the hard work to build out the thinking, build out the adoption among professionals of technology professions, thinking about contributing to how the tech in so many verticals globally has been built up, right? So a lot of financial services tech now sits in India, big banks in the US, globally, right? So a lot of that has been sketched out, and that talent then can spawn the next generation, which created the first version of tech companies in India. And now we are probably second or third generation of tech companies coming about. Services tech talent has transformed a little bit into product tech talent. And so that's short. So that part of the story is well hatched out, right? I think the part of talent that really excites me beyond that is the financial services talent, right? I have worked abroad for last 22 years where I worked, years have been abroad, right? And in those 17 years, I have walked into a number of banks in the US, in the Middle East, in Southeast Asia, here in London, of course, right? In most places, you would find a substantial chunk of middle management will be of Indian origin. It's first generation and second generation Indians, right? So it tells you two things, right? That banking and financial services as a profession is actually looked up to by Indians. That is not the story in many countries, right? It's actually something that folks aspire to. And second, only one shudders to imagine what would happen when some of this talent decides to move back into fintech in India, right? I'm looking at like people like Anurag and Jiten who jumped out of ICI to do startups. I'm looking at people like Chitresh who was here in UK and then moved back to India to do his startup, and a bunch of entrepreneurs like them, right, who can play a very significant role. So when you talk of fintech talent in India, it's trained not only in tech, but it's trained in fin part of it also, which is very important, right? This is a regulated part of technology industry. Being able to understand the vertical that you're playing to involves a lot of not just technical expertise, but a lot of judgment in what the regulator is trying to accomplish and how you play along with it. So that was the third part of our excitement for the India story.
Okay. Got it. What has been your investment thesis in India? What are over the last 2 years, you must have made a lot of investments. So what are those themes around which you've been investing?
Yeah. So look, there are two lenses we can talk about it, right? The first is the kinds of business models we have liked a lot and that we continue to pursue. And the second is ultimately everything has to tie back to a customer segment. Without customers, you won't have any. So especially on the B2C side, you can talk about customer segments. So let's go in that sequence. So in terms of business models, there are three types of business models that are of deep interest to us, right? The first one is what I call full stack business model. The analogy there is, this is Flipkart is the Amazon of India, right? But actually, it's not just Amazon of India. When Binny and Sachin started Flipkart, they didn't have to just send books over internet. They eventually had to build the first crude payment network in India. It was called cash on delivery. Still is called cash on delivery. Still is 70% of transactions, right? They invented cash on delivery, and then they eventually ended up building eCart, which was the biggest logistics company in the country. It's not independent. That's why not a lot of people think of it that way, but it is in terms of its roots and shoots point of view. Right. So what happens in emerging markets is that if you look at any product value chain, it's broken at a lot of different levels. So innovation within a little tiny box doesn't count for a lot. It's a bit like what we were trying to do at Truecaller. If you wanted to just cross-sell loans on a consumer app, there's so many things that are out of our control that were broken that the user experience is not going to be distinctive just because we have solved one part of the puzzle. Right. And therefore, those products won't succeed. So it's very hard for them to succeed. I would say they won't succeed, but it's very hard for them to succeed. So if you're building a fintech company in India, similarly, you have to eventually think of full stack renovation. I'm going to think about the problem across all value chain buckets, and then build tech and ops and everything to solve for all of them. Right. It may not be your starting point, but you should have the vision and the clarity to get there. Right. The best example is OneCard. From day one, right, and building a new credit card challenger in the country. They started with a scoring app because that was the way to acquire customers. But the focus always was that we will be a full stack credit card company in the country. Yes. Right? It has a bit of that vision that he's starting Jupiter for next 40 years, not 4, not 10, 40 years, because he wants it to become eventually a private banking player. Right now, it's a banking platform that is driving benefits from better experience leading to positive selection and being able to attract the right set of customers. Then it will go into a cross-sell sort of hypothesis, and then it will hopefully start going more and more horizontal. But the vision is that it will be a full-stack institution whenever the timing is right. No one's in a rush. Whenever the timing is right, that's the destination for it. So full-stack is a big theme for us. The second theme for us is what we call embedded finance. So again, this phrase these days especially gets used and abused a lot. But from our purposes, embedded finance company is any company that necessarily doesn't operate in financial services, but through its product creates either a proprietary flow of customers or a proprietary flow of data to be advantaged in offering financial services products. And for such companies, then eventually financial services becomes the main model for monetization. Right. So I take an example. We have this logistics company which operates in the Mexico-US corridor. Right. It provides working capital solutions to truckers, fuel cost, etc., etc. Now that's a very specialist vertical, right? And we know nothing about logistics. QED, I would profess, know nothing about logistics. It works because for that company, it's able to target truckers. It's able to get data on which leg are they operating in, how frequently are they fueling up, where are they fueling up, blah, blah, blah. So plain old financial services company would not have access to that data. That data doesn't get captured in any bureaus, right? So you have proprietary source of customers, you have proprietary source of data, which is then helping you lend to those customers in a responsible manner. So those solutions we are quite interested in. There are two sort of companies that are playing into that in my portfolio right now. There is Finance Peer, which is doing a verticalized lending. So it's targeting specifically schools and parents for lending. So if you're a private school, if you're a parent in India sending your kid to private school, the school would want the tuition paid once a year, maybe twice a year. Right? And that creates cash flow issues for you. Not borrowing issues, but cash flow issues. Just 1 month, that amount seems high. And so most people would either save up for that month or better still would cut out some of the discretionary spend for that 1 month so that school fees can be paid out. Right? And Finance Peer says, hey, this doesn't need to be a problem. The schools don't want to run collections. That's why they want all the fees collected upfront. We can take over the burden of running collections. In fact, running your entire finance piece of it, dear school. And we'll break the fees for the parents into sort of 6 months or 10-month installments. So the parents get basically no cost EMI, right? So they don't have to pay financing for it. And then the school gets all the cash up front. It solves problems on both sides of that. And then it becomes a wedge into thinking about the whole ecosystem of how the school operates, ERP software, payments, all of those layers can be layered on top of it. So it can become vertical. The second company, let me take it plays to theme number 2 and theme number 3. So let me just introduce the theme 3 in the so theme 3 is the classic fintech or techfin, as people used to call it, which was providing technology to banks and financial institutions to operate better. What then the new stage there is to say, hey, we don't just need to make the banks work better or help the banks work better, but also help them connect with fintechs, right? In India, especially, a lot of banks have realized that if maybe the first level realization is that digital is a fantastic way of acquiring new customers, right? And so they have the need to connect with fintechs. Large banks, let's say ICICI and HDFC, would have the wherewithal to invest in technology themselves, right? They would have big enough teams and kind of strong enough focus that they can go very deep in. But now it's kind of next level down in terms of size. Those banks may or may not have that wherewithal. Some of them have, others may not. Some may have focus, others may not, etc. But guess what? There's enough balance sheet to be built in fintech that all of them can and should participate. So the upswing takes that perspective that, hey, we will build the pipes to connect banks to fintechs and consumer techs for them to be able to sell products, right? For Amazon, in fact, so on and so forth, right? So that's what Upswing is trying to do. It's trying to bring together not just banking APIs, but contract structures, and perhaps most importantly, regulatory compliance and data security, so that any app can host an Upswing SDK and be confident that everything from a regulatory perspective will be perfectly managed and then still be able to. And it's a headless SDK, so you can have your own brand. Upswing doesn't have any B2B thing. They don't have any B2C ambitions, right? So B2C player, but they power the back end of a bunch of techs. So those have been the three main streams. The company I didn't chance to touch upon is Refine. So that becomes relevant in the customer side of the story, right? So if everyone draws this classic analysis of pyramid, right? Top of pyramid in India, top 30, 40, 50 million customers who are responsible for 60% of GDP. If you allocate proportionally, that analysis is never too accurate. But what like majority, you can imagine majority of our GDP is coming from, a good chunk of our GDP is coming from that top strata. Then you, let's say, are kind of next 150 million users who are the kind of emerging middle class, slightly affluent customers who are getting there, right? And they're responsible probably for, again, the next 20, 30% of the chunk. And then you have the next 200 million who are economically active. And then you have another 200 million. The total math should add up around 800 million, right? Because that's the number of working age adults that we have, right? Younger population means that we have phenomenal number of children, which is a good thing, right? Will hold us in the long term. One card and Jupiter. One card is going after the classical top end of the pyramid. Jupiter is somewhere between the top end and the middle chunk because they're also going to affluent, emerging affluent. But what about the rest? So Refine is saying it wants to, it provides earned wage access to salaried employees in the country, right? So if you're a big employer in the country, you have 500,000, a million, 100,000 employees, then Refine will partner with you so that your employees can withdraw their salary on 15th of the month or 10th of the month, which then can be processed as part of your payroll deduction at the end of the month. And so that becomes a very small way of making salary more convenient. This was really highlighted during pandemic, right? Because you don't know when sickness strikes. And you may or may not be able to wait till the 30th to get your paycheck to afford medicines and whatever care that you need to provide for your family. So that was really the height at which where it got highlighted. But if you think about it, actually, it becomes the structured way of accessing the salary pool of the country, right? And so you can then layer on a lot more convenient financial services on top of it, be it lending. Refine is going after the kind of next tier, if you will, right? The blue collar and the gray collar employees, all the way to the new economy, right? Gig workers, all of that gets captured by Refine, where they can provide these services and then help them graduate to higher tiers of the pyramid.
Yeah. So broadly speaking, lending is big focus area, right? For all three of these.
Lending was the first vector that we went after because that's a business we understood really well. That's where I had big network as well. But we are looking at insurance, wealth management very closely, trying to think of what would be the winning propositions there. IRDA, in fact, has made a lot of announcements to think of new licenses and insurance. They want to grow the number of insurers in the country. So that could be a vertical which could be very close to our heart and which you want to think very carefully about. Management. So far, I've met all the companies that kind of we come across now know of, etc., etc. We haven't been blown away by any of the propositions. You write a check there. Yeah. But that doesn't mean we are not hopeful about the current and new players. We continue to look deeper to see what would make sense for a QED to participate in. For us, we didn't really talk about it, but like there are four main things that we look at. One of the first things we look at in the company is unit economics. Right, being able to maybe not generate money on day one, but being able to at least illustrate economics and have a line of sight into economics that makes sense on a per transaction, per customer, per whatever cost center that you have, right? Per distributor view is very important, right? Since we have operated banks, we understand quite intimately that in financial services, no amount of capital is enough capital to burn. Say e-commerce, right? You can exhaust a whole bunch of capital to get customers. You can exhaust another chunk of capital to get those customers to repeat. But at the end of it, you have repeat customers, right? Here you have a bunch of capital, you can lend it out and they will never come back and you will have nothing. Right. And they will know how to avoid you also in future. You will create empty customers if you. But for us at QE, the first lens is get your economics right. That's what we say. Saying the first filter is unit economics. Once you write economics, then you can spend money on acquiring customers. Right. Acquiring bunch of customers, for example, acquiring bunch of customers and then saying that, hey, something will work out. We'll figure something out. It's not a great QED thesis. Might work for other VCs. It works probably for a good chunk of technology ecosystem, but it doesn't work for us because we tend to be those operator lens and we go into the depth of it to understand why do you think this line item can work, right? And again, we're not going to badger down on 1% versus 2% kind of conversations, but you want to structurally make sure that the products make money. Right, unit economics is the first filter. The second filter, unsurprisingly, is exponential growth. So you can have very good positive unit economics businesses. A classic example, I would say, is the SME lenders. Right, traditionally, SME lending has been a localized business. Right, if a branch in a city lend to SMEs, that means it means all the shops or all the manufacturers in that industrial area or on that street. Right, they inside out. First time basis, they know everyone. So if a machine for which they have lent to whatever manufacturer A stops working or whatever that manufacturer goes out of business, then they know who to sell that machine to. So that level of specialization. So unit economics positive, done, right? Ability to scale exponentially, not done. Because what this model means is you have to go and set up operations and whatever. Yeah, and you have to set up operations in every locality. There's a human involved. You have to train those humans to operate in similar ways, have a nose for similar types of things, etc., etc. Scaling this exponentially with something like technology is very difficult. Right? I won't say it's not accomplishable, but it's very difficult. So that's what the exponential growth filter says that having done unit economics, can we show that this model will then scale exponentially? And again, on day one, it doesn't need to be. And the answer, hopefully, is not always we'll buy more Facebook and Google ads and therefore we'll be able to scale. Well, it's better than that. But that's the second filter we are looking for, right? The third filter then becomes talent, right? And talent, not in there are different stereotypes of founders, right? Venture capitalists always like to think of them as like type A, as a type 2, as a kind of thing. And all of those are important. I'm sure it's a basic kind of curiosity of human mind to bundle things up so they're easy to understand. So there's some classification that goes through. What we are looking for mainly in talent is one above and beyond what one thinks of in technology. Is that someone starting up at fintech truly appreciates the gravity of what it means to start up in fintech. Right? Typically, when you're building a tech company, you have to think of things like org and people, recruitment, but you have to also think of like what will be my technology that I'll build on, what will be the basic layers, what languages, like how important UI UX will be in driving growth. If you're doing B2B, then what kind of API architecture exists there, and therefore what am I going to build there? Build out all of that. So you have a strong point of view on technology, strong point of view on product, and a strong point of view on people, right? Like those are the important things in technology. But you're starting fintech, you have to think of all of those. Plus, you have to think of, hey, there's a regulator here. what do they want? But beyond that, like, what does it mean to run a balance sheet, right? How do you think of a debt structuring, right? How much equity financing? What is your advance rate going to look like? All the way to if you're an insurer, then what kind of loss ratios will you operate on? I can operate on to make sure that your product is profitable, but at the same time, a reinsurer is willing to look at your books, right? Wealth management, like, so what kind of recurring revenues are you able to attract from these customers? Why would they stick with you when other propositions come up? So there are a lot of things that are fintech specific, right? The talent lens is about understanding that the founder appreciates these two things and has thought deeply enough about these things, right? So that when we talk to him or her, then they can bring that across to us. So those are three lenses that we look at companies from to really assess if this is the QED type of company or not.
Why did you invest in Khatabook? Is like in that embedded fintech space, right? Which you spoke about. It's one of your thesis. Plus, it does seem to be scalable as an outsider.
Yeah. So again, I shouldn't comment on specific companies, but there are a lot of use cases that have come up in the market which are trying to simplify back office, classic back office, right? Khatabook is trying to do the actual Khatabook that people used to have, Khatas that people used to have. There are other players and globally, right, that are out there. See, I think cross-sell is a difficult hypothesis to prove. Banking has struggled with cross-sell for the longest time. And if you remember history, then people who have claimed greatness at cross-sell then came out with they didn't have such a generous cross-sell ratio eventually once people started looking closely at books, right? Because there is a sort of compartmentalization of products and services that happens in the human's brain naturally. And there are ways to bridge across that in certain ways. But it's not always easy to think of your accounting books as the way where you would want to then hop on to take a loan. Equally, so being able to do that depends on the quality of the data that's sitting there. Ultimately, all that it comes down to, right, customer access and data quality. So if you think that you're able to capture those data, then it can become a phenomenal platform for cross-sell at a later point. But it has a potential to be, right? Then still the consumer mindset shift that you have to jump against, right? If we just think of them as communication, can I use something that I use for communication for borrowing? Yes, you can. Right? The Chinese story tells us that's possible. It's achievable. But there are certain circumstances that have to be true to be able to make the shift in the customer's mind for the product to fit into that context, right? And then for their interaction to work in a specific way, time and etc. So is it achievable? Yes, it's achievable. But is it easy? Not in any shape or form. Right?
Can you take me through the evolution of a successful company from seed to Series D? At each stage, there must be certain key challenges they need to solve to move to the next stage.
Yeah.
What is your thesis on that?
Yeah, look, in some ways, building a company is about answering a set of questions, right? It's a set of hypotheses, which if all true or if majority of them true or to a significant extent, that will become a big company, right? That's how we think about it. You've written a paper about it, call it the 0.9 to the power of 6 kind of thesis, right? If you have 90% probability of succeeding on 6 questions, in reality, a probability of success is 40 or 50%, somewhere there, whatever point. So chances of success are low, basically is the message. And like, therefore, having to tackle bunch of questions at the same time is not a great way of going about building a company. Again, not saying it can't be done. The probability is still 50%. But if you want to set yourself up for success, then would you do it that way? No, you would probably want to bias the odds a lot more in your own favor. So there are milestones that
don't try to disrupt too many things at the same time. Focus on one key area that you want to crack, or one or two key areas.
Yeah. So you may have to still disrupt a bunch of things. It's not to preclude that you should not disrupt too many things. I think the important thing is what you focus on. What is the question you're answering? Should be maybe one or two questions at a time.
Give me an example. What is this question going to sound like?
Okay, we are starting. So let's say finance PR was starting on day one, right? We talked about the company, so I explained the business model. First thing I would say is, okay, let's prove the unit economics. Let's figure out a few schools where we can go deep, lend to those schools, parents in those schools. Show me those parents pay you back. Show me that there is a repeat story to be had. show me that you can systematically go to 5%, 10%, 15%, 20% of parents in the school over time. Right? And okay to wait. We are no one's in a rush to build a company. Because if it builds, it's a phenomenon. But the first question is unit economics here. That hey, is this a product first structurally that can work? Two, is this a product that parents get attracted to? Is the customer need actually grow? Because one thing to stand outside the school and do a survey and say, hey, you find a product like this, and everyone will say yes, because on paper it looks fine, right? But tomorrow when it comes to filling out the loan application, taking a 1 or 2 day out for the loan to actually come back, and therefore the school be satisfactorily paid, the cashier on the school side recognizing the payment has been made and therefore stops chasing you. All of that are things, right? The micro hypothesis sitting within the major hypothesis. So I would say that's the first question you answer. Prove that, right? Second question then becomes, okay, one particular school or two particular schools have adopted it. Would 10 schools, 100 schools, 1,000 schools adopt it? Why would that happen? So let's set that out, right? So if you have tested this in Bangalore and Mumbai, then let's go and test it in Nagpur and Ujjain, right? And let's go tier-wise spreading out. If you have tested this out with a Narayana, then let's find a local, whatever, private school in Indore and then test it out there, in Jhansi and test it out there. And let's go to a different type of institution and see if it works. If you have tried it at school, let's try it at colleges and see if it works. Right, and universities see if it works. So are there different types of education institutions? Right, so that becomes a second vein of questions that you have to prove, right? And that then starts playing into the exponential scaling part of it also. That can this model actually exponentially scale? And in both cases, in parallel, you're answering the talent question any which way, right? If I need us on the ground to make this work, can I get and train the staff to operate independently in North Zone and West Zone and East Zone when I'm sitting in South Zone? Right? Why would that work systematically? Right? Are there influencers there that can work systematically? Are there schools that think about it systematically? Right? Are the commercials aligned with all of them? Let's think of what are the questions, right? In any business, you can think of it. Like when one card started, the first hypothesis thought of was a customer aggregation. Will it work through something like one score? Today, that app has 20 million downloads, right? It's a phenomenal community of people that they're gathering there. Right. The second thing then they answered was, hey, therefore, can we cross-sell? No, because in India, cross-sell becomes very hard. Also, we started with the ambition of building our own products. So we are going to build our own products. So then they built the credit card product out. And within the credit card stack, also, they went through a set of questions answering them. From your seed to Series D journey, at every point, you should have one major question you're answering, maybe one or two minor questions that you're answering. Question is ever present because you'll need people to solve all questions. So that question is ever present. But then you should have systematically thought of it. It lines up with some benchmarks. So A should be around like $1 million run rate. If we are in bullish markets like 2021, then having a line of sight to $1 million is a great place to be. When we are in bearish market, then going past the $1 million is a great place to be. But somewhere there it lies in one benchmark, then the 10 is the next one, and then 100 is the next one, right? Like, so it's just keep up with the explanations. But something around those ranges. 10 ka 5 POs are there depending on if you're in a B2B vertical. Scale-ups take slower, but then they're more rec. And so therefore you might be able to live with a slower number of revenues. So yeah, that's how there's a numeric aspect to it, but I think the judgmental aspect is far more important. So when you talk to a later stage company, we typically ask them, what are the questions you're trying to answer? What are the cards you're going to turn over? To be honest, life is more complicated than this conversation, right? So when you talk to companies, then they would be like, hey, now licenses are becoming available, or now this opportunity has opened up, or there is some regulatory change and therefore new segment has opened up. Those can also be very powerful drivers why we think we can accelerate the company to the next vector of growth. But again, opportunities present themselves, right? But as a founder, your job, or as a group of founders, your job is to simplify it into a series of questions that you're going to answer. Right? So be very clear about which is the most important one right now.
So one of those things about what makes a company successful is to have very clear questions that you want to answer at each stage. What else is there? Things which make a company successfully scale?
Yeah. So look, I think the classic things always hold, right? Being able to attract the right type of talent, being able to inspire them. That by far is the most foundational question. In my operating roles, it always came down to a people puzzle, right? There are only so many problems that you can solve on your own. where you can be present in the conversations. And frankly, at some scale, that becomes practically irrelevant, right? What becomes far more relevant is people who are discussing, driving, doing things on the behest of the company, and having the right set of people in those seats and having the right sort of motivation for those people is much, much more important, right? In fact, it's the only thing that will actually deter, like everything else is on paper, right? This is when rubber meets the road. So you can have all the best unit economics and you can have wonderful abilities to scale exponentially. But if you don't have people to execute on those, then frankly, everything else becomes irrelevant. Right. So the question is always the most important, right? Founder should always be thinking about that. Seed, Series A, Series B, Series C, Series D, public, 10 years public, right? That question will never change. Always the most important question by far. Right? Ultimately, any company is a collection of people. Having clarity of direction and purpose is very important. I think third thing, and they may not be necessary in that sequence because these are all important things, but having vision is very important, right? As a founder, you get rejected far more then you are accepted, right? Every single thing is a bit of a push. Recruiting is a push. Getting your first, second, third sales contract is a push. Getting customers to adopt your product is a push. Getting them to repeat is a push, right? Getting investors to invest is a push, right? There's a lot of pushing, right? And so what owns you, what drives you, right? At the very heart of it is then I think the vision part, right? The reason why I'm building this, but also how far and how big can this be is actually the driver in my mind, right? As an investor, what it tells me is, hey, when I talk to you, can you paint me a picture of what this company would look like with 100 million revenue? Give me that picture, if you will. And what were the complexities associated with that picture that you're thinking of today? And what are those that you'll think of tomorrow? And why? And all of that becomes a very interesting conversation. But in essentially, in a sense, right, what you're really testing there is, can the founder envision an end state that is inspiring, exciting for them? Because that's the vision, then eventually some version of that they'll sell to all other counterparties involved, right? They'll sell it to investors, they'll sell it to employees, they'll sell it to their customers, they'll sell it to their suppliers. Having a sense of vision, the rationale for it, almost missionary zeal, if you will, is very important.
For like fintech space, wouldn't the balance sheet, the way you structure the balance sheet, also be like one of those critical things, like how much debt you take on and things like that?
See, technical skills is important for sure, but somewhere in that vision, if you're especially thinking about fintech as a end state, there will be questions about regulation and there'll be questions protecting customers' interest, which should automatically surface. Right? For example, there are a lot of places, without naming anyone, there are a lot of places for making cheap. You can easily sell something worth $2 or $5 and make $3 off it and keep doing it till people realize that you have an inherent arbitrage that you're trying to adopt, right? There are any number of companies that we come across who are kind of built on these specific niches of where customers don't recognize the pricing, how it's inherent in the offering, and therefore they're able to capture the economic margin. Some places it's justified. Other places, for example, is just lack of disclosure and lack of understanding, right? And those are the kinds of companies where, yeah, the founder has a vision, right? But the vision is not really attuned to regulatory standards, perhaps even ethical standards in some way, shape, or form. Is not the most customer friendly, right? Your vision should be about customer delight, right? You're delivering something that is far superior to anything else on offering, because that's the easiest way to get economic value. Right? Easy. When I say easy, yes, I'm not saying easy in sense of it's being fast. It's the most sustainable way of creating value. The rate of protecting value. Because if you're creating genuine economic value, right? Something that used to take you $5 to get to, but I can offer it to for $4 and produce it in house for $2, then I have captured a margin. Right? Then it's economically accretive to everyone. You're creating value for everyone in the ecosystem, and therefore you will go faster and grow forth without structural issues, right? So I think the point is bang on, right? Being able to understand regulatory and balance sheet aspects of it is very important. But I see that as being an inherent part of the vision. It's rather than an additional thing, right? There are a lot of additional things, to be honest, that you need to have a tech founder who understands what is the underlying tech of. You need to have someone on the financial side of it so that they can understand balance sheet, actually help you fund the balance sheet and run it in a structured manner. If it's a lending company or an insurance company, then you need someone with very strong credit background. If it's an asset management company, you need someone with very good investment understanding, right? Both are technical jobs, but you need to be either one of the founders should be proficient in those skills or be able to recruit, right? Ideally, one of the founders should be proficient in those skills. So those things are needed, but they are table stakes. So as you said, they are things you need to play the game.
Okay. So you would be getting founder requests for to meet because they want to pitch to you from a variety of sources. What is the source you value the most? That if a founder comes through this source, then I would surely want to meet him.
Yeah. See, true to QED, now we analyze backward looking which sources have been most valuable. So it becomes sort of a self-fulfilling prophecy also, to be honest, if I'm being completely honest about it. But there is an inclination and tiering between them, right? Like referrals tend to typically be the strongest source. Referrals from other founders, in fact, are the strongest source, followed by referrals from other investors, existing investors. But founder referrals are usually the strongest. What's a blind inbound, as we call them, where a founder just writes to you on email directly, quite mercurial. So we have found some phenomenal companies there because our founders were just so amazing and they were undaunted, so as to say, right? They're confident of their vision and knew that QED was the right investor for them, that they left no stone unturned to reach out to QED. And those have been fantastic investments. But the important thing is to be able to distinguish from the noise, because a lot of folks will reach out directly, right? Yeah, my LinkedIn in particular gets bombed like crazy. So you should be able to distinguish yourself very, very quickly on why you are the one, right? But if you're able to, then that source is not bad. Frankly, I've done very little of outbound, like us reaching out to get to founders. Our main thesis is that you will have the brand and the openness to be able to attract the best founders, right? The positive selection is very important for us. Like founders should think of QED as like a destination VC, right? If I'm starting up something in fintech, then having QED on my cap table would be magic. Hopefully, we are able to get to that point of view, but that's an aspiration nonetheless. And so, inbound will be the main source for us even going forward.
Okay, your limited partners who fund you, are they from India? Are they from the West? What is the makeup of that?
So we are a US fund inherently, right? Okay. So most of our LPs sit in the US. There are diversity across educational institutions, long-term money managers, all the way to family offices. And frankly, Nigel himself is a big LP for us. Still is. So it's a mix of institutions, but we have very little penetration, if any, in India. That's something that we need to work on to kind of get more money from India for India, right? I think that should be a source of capital for us. But right now it's all international and abroad.
Okay. Does it make any difference to the company on whether the money is raised from India or from outside? Is there any transaction cost of raising from outside?
For the company, so you're talking about a company incorporated in India raising money from foreign investors. I think there are a few things to be mindful of, right? There are no restrictions from RBI in terms of money being invested into fintech. But if you're operating a regulated entity, right, if you're raising into an NBFC, then you need to be a bit more thoughtful about, because what the regulator essentially cares about is that the decision making should sit within its jurisdiction. And so there are a lot of shady ways in which foreign companies can own companies in India and the decision making then sits abroad. Clearly, that's not the case when venture investing is happening. I'm not going to sit here and make decisions for Indian market. But you need to be mindful that would be one of the scrutinies that you may have to go through. So to think about what that would mean. Right? It practically means that from an ownership perspective, there are no restrictions for us. We can own as much and go as deep, but we just have to be very clear in terms of the company charter, the way what the reserve clauses are structured, how the governance works, so that the decision making sits firmly in India. And it's very transparent to anyone looking at the company from outside it. But like in our journey in India, and I know from a lot of foreign investors as well, we have never had any issues on this, right? And in fact, most funds based in India are also actually domiciled abroad, right? Sequoia, Axel, Matrix, Elevation, all of these funds, actual money is sitting abroad, right? The investors are sitting in India, but not just the advisors to the fund. The actual fund sits abroad. So it is all foreign capital in that sense, right? So it has not been an issue for the longest time in India. India has been very set up for that. Of course, there are matters regarding taxation and how easily and quickly can the money come in and come out. All of that can be improved, right? Those are all ease of doing business kind of thing. But structurally, it's pretty well set up.
that taxation would only kick in at the time of exit, right? Like when you're investing that startup which is receiving the funds, there are no transaction costs, taxation costs for even if
Unless you're coming in through, yeah, unless there's a secondary component to your investment. So then taxation could come in upfront. You'll need to get your tax IDs and all of that. The second part of it is like how deep is the KYC? How is that done? At what level is it done? You would prefer like a one single window clearance where you're accredited by a central authority and then basically anyone, as long as you have that certification, everyone else is fine with it. But what tends to happen is for every transaction, you go through a process. So there are things to simplify, right, which will make it much faster, right? The parallel I hold is if it's a Delaware C corporation that we are investing in, right, the investment would close in a month and a half. Whereas if you're investing in an India domiciled company, that would probably take 2 or 3 months to close, right? So those are the kinds of, that's the delta. But again, as kind of people get better and better at these things, as venture becomes deeper and deeper, things are just getting faster and faster.
do you see funding drying up from the perspective of your ability to raise from LPs in India, in the startup ecosystem in general? Most founders talk about how there is a slowdown in funding and the numbers also back it up. Does it similarly also get experienced at your level where you see your LPs are not as willing to back your next fund, for example, and so
Yeah. So QED is particular is not facing anything like this, but I can imagine that happening across the ecosystem. See, from an LP is a money allocator, right? Asset allocators in some way. So they have to allocate a certain part of their balance sheet towards private funds and a certain part towards public funds. So now as public markets have underperformed, then the proportion gets reversed, right? Suddenly you look overweight in private markets because your publics have dropped. And private doesn't get marked up as frequently, so it doesn't get marked down also as frequently, right? So you look overweight, so then that creates an allocation issue. But those are the wide phenomena. From an LP perspective, the QD proposition is that we are a specialist investor, right? So we have the high beta returns of financial services. We have the high beta returns of tech into our asset class, if you will, which distinguish us from other private investments or other VCs that you would invest in. And it will also distinguish us from other specialist funds that you distinguish in. Right. So as an asset class, we are quite distinguished within their spreadsheet or within their book. Right. And frankly, we are not that big in the ecosystem, right? If you look at the universe of private investors, investment opportunities across hedge funds, venture capital, private equity, growth equity, all of those, right? Restructuring, special opportunities fund, all of that goes into that 30-40% alternates bucket, right? Within that, like you're $1 billion fund. And so $1 billion is huge from a venture perspective. But from an alternate bucket, it's not that significant, right? Not that big.
Okay. What do you mean by high beta? Use this term.
High beta means it's a public markets analogy, but if you analyze sector returns, right? So if you have ETFs or exchange traded instruments or index funds, right? For every vertical, for financial services, manufacturing, agro, consumer goods, that is, so on and so forth. And you analyze movement of these indices relative to the overall stock market index, right? Then some of these would have a lot of volatility associated with them. When the market goes up, they go up a lot more. When the market comes down, they come down a lot. Right. And some of them will be counter cyclical. When the market goes up, they actually go down or they plateau. And when the market goes down, then they can continue to stay flat. So they're relatively robust, right? And you can think of like infra and all of that will be relatively more stable, slightly debt-like, if you will. So they're more stable and then you would have more volatile. So typically technology index and financial services have very high betas.
And beta means it's more volatile. Like that term.
It's more volatile. So when the market goes up, then it's even jumps up even high. And then when the market goes down, it corrects to the extent that we are in down cycle. Then financial services and tech are a great place to invest your money in because whenever the market goes up, then these indices should rise a lot more. So you should take that. And the reason for that high beta is obviously market performance, but there's also the underlying structure of earnings, the underlying structure of companies, the value they add, all of that, right? It comes into a lot of structural factors. So if you take that analogy and apply to private markets, then fintech should be the part that should be swing up again when the investing climate.
Are you at all interested in DeFi, decentralized finance? Like the evolution of
No.
fintech over a decade or so would eventually be DeFi, right? Do you not believe that?
No, so we actually pay a lot of attention to crypto. I would say we are not the most forward-looking investor when it comes to crypto. We were fairly late to the party, is the way to put it. But essentially, we were very cautious because we didn't fully understand the technology and we didn't understand the full implications of the technology. So being the market the way it was last year and the year before, we were very cautious. We have done a few investments. We have a board position on an exchange in Mexico. We have a crypto payments company where we sit on the board in Canada, for example. So we did take a few calculated bets into the vertical, but we are quite cautious because we wanted to understand what is really going to happen here. And so our CIO, actually, Frank Rotman, he probably spent like 50-60% of his time looking at crypto for last year and half, trading with his own money. So he gets a good sense of it, but also doing small investments to get a broader sense of the community, understanding the community, right? What is driving it. And he really spearheaded us thinking on crypto in many ways. We individually as partners also, so I have placed a small bet in Motrex, which is a crypto company in India, but talked to a bunch of them as we evaluated Motrex, but as we evaluated beyond it, etc., etc. See, our main kind of takeaway were twofold, right? One, it's a bit of hammer looking for a nail. So we don't really we don't think of, is currency the right problem to solve or not? We are not fully bought into it, right? It is the right problem to solve. There is a bit of it. At the same time, there are aspects of it which are evident would have some applications. So tokenization, especially as it applies to reward streams and other non-monetary forms of signaling, could be a phenomenal use case. So there are some use cases which are of value. I think infra companies in general, we are optimistic on because again, we think it's a phenomenally powerful hammer. So anything that makes the hammer even better should be of value. But the nail, I don't think we have found it yet. Right? We don't know exactly what the problem is that we are trying to solve. Right? Because going back to the origin of money and all of that, right? It was supposed to be a medium of exchange and a store of value. And it had value because someone said that this has value. Right? So can you have a group thinking that this has value and therefore it will retain value? Surely in this situation, yes. But if you really trace back the origins of money, then no, it was because the king, the big man in the village said that this has value, therefore it had value. So someone had to stand behind it, and someone's physical might have to stand behind it for it to hold value. So today, say anything that everyone believes will have value because we are all democratized and sort of individual aspirations and all of that. But the heart of financial system did rely on might of an individual, if I may say so, individual or what an institution. Can you structurally solve for that trust? Surely you can. Yes, you can. But is that going to be just us believing? Maybe not. Maybe there are more nuances to it that we need to think a bit more carefully. And then especially in context of emerging economies, right? Like India has had very strong currency controls for a very long time. Right, since independence, but probably even before that, I haven't studied, but since independence for sure. Right, even today, if you want to take more than $250,000 out of the country, it becomes phenomenally difficult. And there are very good reasons for it. Right, whose laws and protections are actually done well to India. If you look at history, so will the institutions in the country just abandon these controls? No, that's not going to happen. Will they recognize the value that a technology like this can bring? And if we think that it structurally is better value, then will it actually get adopted in some shape or form? Yes, because from a leading indicators perspective, very forward-looking regulator, development government, development-oriented finance ministry, blah, blah, blah. So therefore, there's value on the table. They will see it and they'll adopt. But there's also value in the restrictions we have. And I don't think those are going away anytime.
You said tokenization is a use case which you can get behind. What do you mean by that? Give me an example.
Jet Airways, right? We all used to fly Jet Airways and those jet privilege points were of lot of value.
Jet miles, I think you call it or something.
Jet went away. Those points still stuck around for some time for people to monetize them. Frankly, I think I lost balances there, so I didn't keep track of it. But had it been tokenized and it been tradable in some shape or form, is a value would have been protected.
Oh yeah, I can see that. Yeah, that would be super interesting. And that brings us to the end of this conversation. I want to ask you for a favor now. Did you like listening to this show? I'd love to hear your feedback about it. Do you have your own startup ideas? I'd love to hear them. Do you have questions for any of the guests that you heard about in this show? I'd love to get your questions and pass them on to the guests. write to me at ad@thepodium.in. That's ad@thepodium.in.